Module 1. Underwriting of corporate securities. 1. Define underwriting. A. Underwriting may be defined as a contract entered into by the company with persons or institutions, called underwriters, who undertake to take up the whole or a portion of such of the offered shares or debentures as may not be subscribed for by the public. 2. What do you mean by underwriters? A. The person or institutions underwriting a public issue of shares and debentures are called underwriters. The underwriters may be individuals, partnership firms, joint stock companies, banks and financial institutions. X. Assisi, SFCs, LIC, etc. 3. What do you mean by underwriting commission? A. The underwriters are entitled to some consideration for the risk they undertake in underwriting the shares or debentures of a public company. In the words, the consideration payable to the underwriters for underwriting the shares and debentures is called underwriting commission. 4. What is sub-underwriting? A. When there is underwriting between two underwriters, it is called sub-underwriting. 5. What is marked application? A. The applications received by the company bearing the official stamp of the individual underwriter or the respective underwriters are called marked application. 6. What is unmarked application? A. Those applications which are directly received by the company and do not bear the stamp of any of the underwriters are called unmarked applications. 7. What is complete underwriting? A. In case the entire issue of shares or debentures of a company is undertaken, it is said to be full or complete underwriting. Such an underwriting may be done by one underwriter or by a number of underwriters. 8. What is partial underwriting? A. When the underwriters do not undertake the responsibility for the whole issue but underwrite only a portion of the issue, it is called partial underwriting. In such a case, while calculating the liability of underwriters, the company itself is deemed to be the underwriter for the balance not underwritten. 9. What is firm underwriting? A. If the underwriters make a definite commitment to take up a specified number of shares or debentures irrespective of the result of the public response to the issue, it is called firm underwriting. Module 2. Profit prior to incorporation. 1. What is profit prior to incorporation? A. It is the profit earned or loss suffered during the period before incorporation. It is a capital profit and is not legally available for distribution as dividend because a company cannot earn a profit before it comes into existence. Profit earned after incorporation is revenue profit, which is available for dividend. 2. What is pre-incorporation period? A. It is the period from the date of purchase or acquisition of business to the date of incorporation. 3. What is post-incorporation period? A. It is the period which begins from the date of incorporation and ending with the last date of the accounting period. 4. List out the apportionment of time ratio. A. The fixed expenses like rent, salaries, insurance, audit fees are apportionment on time basis. 5. Explain the calculation procedure for sales ratio. A. It is used for dividing expenses related to sales. It is calculated by taking into account the sales of the pre-incorporation period and the sales of the post-incorporation period. Module 3. Valuation of goodwill. 1. What do you mean by goodwill? A. Goodwill is the extra value attached to the business over and above the intrinsic value of its net assets. In other words, it is the value of operations or good name of the business. 2. Define goodwill. A. Goodwill is an intangible asset arising from business connections or trade name or reputation of an enterprise. 3. State any two features of goodwill. A. Goodwill is an intangible asset and goodwill is a real asset but not a false asset. 4. What do you mean by maintainable profits? A. Profits which are adjusted in the light of future possibilities are known as maintainable profits. 5. Give the meaning of divisible profits. A. Divisible profits refer to that type of profits available for distribution as dividend. 6. What is super profit method? A. Under this method, valued at agreed number of years of purchase of the super profits of the firm. 7. State any two circumstances to valuation of goodwill. A. When a sole trading concern is converted into a partnership firm or a joint stock company and on admission or retirement or death of a partner. Module 4. Valuation of corporate securities. 1. What do you mean by valuation of securities? A. Valuation of shares is the process by which the intrinsic value of the market value or the fair value of the share of a company is determined. 2. Briefly explain the need for valuation of securities. A. In most of the cases, stock exchange quotations are taken as the value of shares. But some circumstances the stock exchange quotations are not available for some shares or they may be inadequate for the determination of value of shares of a company. In such special circumstances the need for the valuation of shares arises. 3. State the methods of valuation of shares. A. Asset banking method, net asset method, balance sheet method, intrinsic value method, yield method, earning capacity method and fair value method. 4. Mention any four circumstances under which securities have been valued. A. At the time of amalgamation of companies. B. At the time of absorption of one company by other company. C. When a large block of shares is purchased so as to acquire controlling interest in the company. D. When shares of one class are converted into shares of another class. 5. State the meaning of term net assets. A. The term net assets mean excess of the net present value of all assets over the present value of all liabilities of the company. It refers to the assets backing shareholders' interests and it is the intrinsic value of shares. 6. How do you determine the fair value of shares? A. The fair value of a share is the average of net assets value and yield value of shares. The fair value of a share is therefore determined by adding the intrinsic value and the yield of a share and dividing the total by 2. 7. State any four factors to be considered for valuation of securities. A. The nature of business of the company. The earning capacity of the company, the demand and supply of shares of the company. The economic and political conditions in the country and the value of goodwill of the company. 8. How do you calculate intrinsic value of a share? A. Intrinsic value per share is ascertained by dividing net value of assets available to equity shareholders of number of equity shares. Module 5. Financial statements of companies. 1. State the meaning of financial statement. A. Financial statements or budget summaries are fundamentally reports that portray monetary and bookkeeping data identifying with organizations. An organization's administration utilizes it to speak with external partners, which incorporate tax authorities, regulatory bodies, investors, creditors, shareholders, and so on. 2. Define financial statement. B. The financial statements provide a summary of accounts of a business enterprise, the balance sheet reflecting the assets, liabilities and capital as on a certain date, and income statement showing the results and operations during a certain period. 3. What is profit and loss account? A. Profit or loss is the net income which is obtained by deducting the expenses from the revenues. Profit will happen if revenues are more than expenses, and loss will occur if expenses are more than revenue. 4. What is balance sheet? A. A balance sheet is known as a statement of financial position as it shows the position of assets, liabilities and equity at the end of an accounting period. The net worth of a business can be determined by deducting the liabilities from the assets. 5. What do you mean by depreciation? A. Depreciation can be defined as a continuing, permanent and gradual decrease in the book value of fixed assets.